3 on core CPI. Progress on the key components of inflation that the Fed cares about. Get that, then I think we're with our call for no hike next. It's data dependent, and I think everyone Canada said, what was it conditional on? It's conditional on.
Colin, what's your call?
I think the key point with Canada is that conditional pause. They hiked, they told us that they're going to see what happens, and then we heard enough. And I think that's the same approach they're going to take. They're not going to their plans next week based coming in. We did get softer reading today, although that's just one data point. So we're going to need to see a few more prints like that before we get proof that there is more of a slowdown coming. But I think it does come down to the inflation outlook. Disinflation came a little bit and it's kind of stalled, and the Fed wants to see how that progresses. So we don't expect a hike next week. We actually the odds of a hike in July are a bit lower than what the markets are expecting. But at the end of the day, the door is open, and this is giving them time to really evaluate how their policy is rippling through the markets and what it means going forward.
Colin, let's talk about that statement from Governor Tiff Macklem. That policy was not
about that, where he acknowledged that we just got to a level that's restrictive in his camps, but it does be seen how restrictive policy is right now. Yes, in an absolute term, Fed funds rate over 5%, it's the highest we've seen in a long time. We think it should be restrictive, but if we look at what's happening with the economy, especially with a lot of the hard data, plenty of surveys are telling us that things should slow down. But when we look at consumption trends and spending trends, and then especially with the labor market, which may be starting to loosen, but is still admittedly tight, maybe it's not restrictive enough. So I think that's going to be a key point, but we're still in the camp that there is, and over time, all of those survey-based sentiment we do think that that should lead to slightly and then a down.
Seth, I remember a note you put out post, I think it was in late March, rating policy, particularly after the stress we'd seen in a financial system. Has that got easier? Got harder?
No, I don't.
Which one?
I don't think it's got any easier at all. We may have to have different people on the show because Colin and I are very much in alignment at this point. It remains to be seen. There are lags of policy. I think everything that happened with the banking sector reveals the need for the Fed to assess over time just how much restraint is being imparted on the economy. Our forecast is that not only are they not hiking next week, they're also not going to in July, but I will go back one more time to say it is a conditional forecast, conditional on us getting the data forecast right, with inflation continuing to trend down and a bit more softening in the labor market.
Seth, do they have the luxury of being wrong? The reason I ask that is if they are wrong and it takes longer for this to get back towards target, do you think there's a window here, a risk that it becomes more embedded? Do you have a window where you have to deal with this before that risk materializes?
I mean, I think the fact everyone has to accept is that everyone is going to be wrong, including the Fed. The question is how much and in which direction. In the context of whether or not inflation expectations, for example, will become unanchored, whether this inflationary process becomes embedded, I personally don't think so. At least there's no evidence of that yet. If we look at survey measures, if we look at break-evens, it does look as if in the longer run inflation expectations are still under control. I don't think they bite. But, you know, again, as Colin, the funds rate up over 500 basis points from the balance sheet is still, it is hard to anyone would conclude that the Fed has just thrown in the towel on inflation at this point.
Hard to get data at the moment, Seth. Claims were lower. There were distortions associated with the data coming out of certain states, and now they're higher again, and we're wondering whether there are distortions associated with certain states all over again. Seth, how would you read that surge in claims this morning?
I would read it as 1 week worth of data that goes in the direction of being softer, but by no means would I change my overall view on the economy based on that one data point. It's just too noisy.
Put it together with the jobs report on Friday, Colin. What kind of state is this labour market in?
You know, it still seems pretty tight right now. I'll joke and go go to a point Seth made, you probably booked the wrong people here. We're in total agreement right now.
I'll start
Jobless
disagreeing with you
claims number
both.
this morning. The jobless claims number this morning is just one claim, but we would expect it to start trickling higher. That's been the kind of the mismatch we've seen that has admittedly been longer than headline companies, also then kind of trickled into the financial sector of layoffs. And then we weren't seeing it in the initial jobless claims data, nor were we seeing it in the payrolls data. Maybe we trickle in as these lags employment rate continue to rise. Because if I think it does continue to rise, even if it's by a tenth or so, that supports the case for the Fed to pause and really see what's going to happen over the next handful of quarters.
Seth, I've had a lot of questions, people running in about the labour market report from last Friday, the establishment survey, which goes into payrolls, the household survey